I don't know about you, but I have definitely noticed the price increases, and it's made me consider and feel a little concerned about my savings. Will they be sufficient for my retirement? Is my cash secure? If you find yourself thinking the same thing, do not worry. I have some helpful advice today to assist you survive in inflation and save your finances. You can also acquire a free copy of my savings and budgeting advice if you're interested. Alright, so let's get started without further ado. 1. Assess your own spending plan. Setting up your personal budget is a great method to start saving money, but you should rethink it if inflation is a factor. I'm not advocating doing away with the budget entirely, just making adjustments to it. There are definitely some expenses you can eliminate from your budget. I'm referring to those that aren't high priorities. You'll have more money in your pocket if you lower your spending by eliminating some budgeted costs. The good news is that there are a ton of methods to cut costs. For instance, if you're accustomed to eating out, I think it's time you start in cooking for yourself, since it's less expensive and healthier. 2. Make purchases of pricey goods. We occasionally make investments entirely out of self-interest. The truth is that the worst kinds of investments to make during inflationary times are long-term, fixed-rate, interest-bearing ones. What a mouthful. This category includes all fixed-rate, interest-bearing debt securities, albeit assets with maturities of 10 years or more are preferred over others. Instead of doing so, invest in things that are difficult to replicate, such as gold, real estate, or land. You might also begin amassing unusual stuff, such as cards or antiques. All of these items are assured to retain value during difficult times due to their unduplicatable character, preserving and expanding your money. 3. Examine your allocation of investments. Consulting your financial counselor is a highly wise move when inflationary times start. You must confirm that the investments you've made align with your level of risk tolerance. Take as an example a suitable asset allocation of 60% equity and 40% fixed income. If you are income-focused, you should also think about investing a portion in stocks that provide dividends. In the past, bonds have had a harder time than equities keeping up with inflation. Reviewing your financial portfolio is one of the most crucial components of money management. Your investments could easily deviate from your initial plans if you don't monitor them. As a result, you should properly analyze your investment portfolio. The first step in any evaluation process is to locate every single asset you own and list it in one place. 4. Recognize the motivations behind various assets. Investments to think about include commodities, cyclical stocks such as those in the financial, materials, and industrial sectors, and overseas equities. When they should know the basic forces guiding the various assets, some people are frequently duped by historical connections. Treasuries and stocks may have a negative connection, but if inflation increases, both of these asset classes lose value. 5. Combine your investments. Inflation is one of the elements you need to take into account when you want to make changes to your portfolio. In order to survive a period of unpredictably fluctuating stock market circumstances, investors must diversify across a variety of different asset types. I think it's crucial to combine a variety of investments that are unique from one another in order to stay up with rising pricing. You may protect your money by diversifying your assets so that even if one doesn't work out, you can be confident the others will. It's the market after all, and you never know when the balance will shift. 6. Keep an emergency fund. The majority of people make the error of making large investments in order to combat inflation. Despite the fact that it's a smart idea, you should first make sure that you have enough to last you through inclement weather. Although it's advised to have 6 months' worth of expenses saved, having at least $1,000 in your emergency fund should be taken into consideration if you genuinely want to live stress-free during challenging inflationary times. For your emergency fund and other short-term resources that you need easy access to, use a high-yield savings account. CDs help your money grow a little faster than a bank account or traditional savings account that pays little to no interest. The conventional savings account does assist in reducing inflation, even though it does not pay enough to do so. Before you start saving for an emergency fund, you should pay off your bills. 7. Examine the bond industry. When you are debt-free and have enough cash to cover 3 to 6 months of living expenses, you should start looking into investment options that will increase in value at a rate that keeps up with inflation. The success of some of these investment alternatives, such as bonds, is assured. Bond interest rates are always revised every 6 months as long as inflation keeps rising quickly. Bondholders receive their money back at maturity along with regular interest payments. Therefore, there isn't much to lose by doing this. 8. Make home improvements. Home prices have been rising rapidly over the last few years. For homeowners, this is excellent news, but it's not so good for the few who want to enter the market. Experts predict that despite rising mortgage rates, property values will remain high. Despite the high expense of maintenance, I would still suggest making improvements to your current home before purchasing a new one. All prices normally increase as a result of inflation, including rent, home prices, and mortgage rates. As a result, you should postpone your house purchase if you fear inflation may be increasing. Purchasing your own house has numerous benefits. Like homeowners are safeguarded against rising rental costs because their cost remains constant regardless of the situation of the market. 9. Consider fixed accounts that are short and medium term. You should always check your retirement account and get ready for the coming recession whenever there are symptoms of inflation. It is wise to take into account short and mid-term fixed accounts, such as 2 to 5 year fixed annuities. While money market accounts and bank CDs give little to no guaranteed rates, a short to mid-term annuity can offer up to 3% fixed income at current rates. 10. Continue to hold growth-oriented stocks. Even when we occasionally do save a lot of money in savings accounts, inflation always manages to catch up with us. The fact is, you should now begin making investments in stocks like growth stocks. Your finances will expand in this manner despite inflation. Maintaining your investing position with a preference for long-term assets like stocks is the wisest course of action in circumstances like these. Stocks perform best when inflation is between 2% and 4%. 11. Avoid keeping more savings than necessary. The most prevalent fallacy is the idea that the more money you have in savings, the safer you are. It's undoubtedly true, but it's not a good idea when inflation is high. You should look for additional ways to expand your money rather than leaving it in the bank. But keep in mind that bigger gains often mean bigger risks. The best way to increase your money for long-term goals like buying a home, funding a child's college education, or retiring is by investing. Stocks are most likely to surpass inflation over time since they have the highest potential long-term gains. 12. Boost income, both active and passive. You may suffer from inflation, especially if you don't have a strategy in place to combat it. You should have a side job to help you pay the expenses if your income isn't high enough to keep up with inflation. Some of you are already doing a side job, but you're still having trouble making ends meet. There is a simple solution to stop this, though. Inflation is often expected to increase by 5% annually, but as of right now, the U.S. Labor Department reports it to be 8.2%. Therefore, you must be sure that your income has increased by at least 8%. Look for alternative strategies to increase your income. To make some extra money with a little more effort, one recommendation is to think about renting out any extra rooms, storage units, parking spaces, or pricey tools like lawnmowers or snow blowers. You'll be safe if you follow this advice. 13. Recognize that not every investment will be impacted. There are always hazards associated with investments. The major deterrent for some people from investing is this. The fact is that terrified money doesn't generate any revenue. When you invest, you'll undoubtedly lose some money, but you'll also probably make some money on other investments. In the present market, such outcomes have become the new standard. Therefore, before investing, if you're worried about losing your money, consult with a financial or investment counselor first. You'll obtain assistance and advice from experts in this method. 14. Avoid making any rash choices. Some people have erred by hastily choosing to invest in the money market only out of concern for inflation. You should be aware that this can occasionally be really dangerous for you. Now simply take your time and conduct the necessary research rather than making snap decisions while inflation is present. Smarter shopping. 16. When there is inflation, doing this is unquestionably the simplest thing you can do. If you were accustomed to purchasing your food from a pricey location, you should look for a less priced option. Spending as little money as you can should be your goal. In this manner, even when the economy is rebounding, you will be saving more money. It's not necessary to break a sweat in order to beat inflation. I'm confident that with the few pointers I've provided, you're off to a solid start. You need to carefully consider your options before deciding what to do or how to combat inflation. Some might succeed while others might not. However, if you fail, try again without giving up. Thank you so much for watching. Please give this video a thumbs up if it was useful, and be sure to subscribe to our channel for more videos like this. Thanks for watching.